Vikas, from your global lens, what are the big macro trends that you foresee which are impacting equity markets across the world?
So what we're dealing with more and more these days, and we've been having these conversations for a long time, it's always wonderful to come back, but this era is different from previous eras, certainly from when we started talking 15 years ago, in that technology and public policy keep coming up as the main drivers of equity markets. Fixed income also, but my focus is equity markets. Sometimes it's a little bit more policy, sometimes it's more tech. But if you look at North Asia, just over the past month, semiconductors, memory, semiconductor production equipment. If you look at policy when it comes to pharma names here, or you look at the defense sector in Europe and in India and in Japan this year, public policy, demographics, technology all coming together to drive opportunities in the short to intermediate term. Also, what I would say in the long term, one of our foundational beliefs is that markets will continue moving higher because they have to. So if you look at the Value Up program in South Korea, the corporate governance transformation underway in Japan, the fact that Xi Jinping is now allowing entrepreneurs to make money, the markets to go higher and higher in China, it's because we don't have very many mechanisms for people to preserve and then grow their wealth. The stock market is the best way. I know in the short term there are concerns about AI bubbles or valuation multiples in the short term. But our view is that for many reasons, including demographics, markets will keep going higher because they have to.
Why do you say they have to? I mean, there have been periods of extended and long bear markets as well. Cases in point like Japan, or for that matter, China, took very, very long to come back from the COVID lows. So why do you believe that we're in a structural upswing in equity markets and that this is going to continue?
It will continue. It might not be any one. Not all markets will move uniformly.
Sure.
So we've seen that this year. Look at the wides of India versus emerging markets, India versus developed markets. By the way, that's improving the setup into 2026. We can talk about that later. It's a little bit too early to talk about 26, but India's setup heading into next year is looking pretty good. And so we've seen dispersion this year, but overall, tech will drive it, policy will drive it, defense sector, infra spending, education, healthcare. All these sectors are going to drive equity markets higher because that's where the growth is. And this is a great home, a great time for active stock picking as well, whether it's at a country-wise allocation level. Coming into this year, we were underweight India. In our India strategies, we've been fully deployed. But relative to the bottom-up opportunities we saw in Japan, in South Korea, in Europe, in China, and Hong Kong, we thought that it served us better to have more capital allocated there. So not every market will move together, but the trend is clear to us. It's going to be higher. I could have stayed home in the US and invested in that market. I could have picked a different asset class. I've chosen to do public equities in Asia with a focus on India because I think that's where the money is.